Bank of America's brand is under attack again. Citigroup is going to new places, and banks are getting ready for the next crisis. This is where the money is. So David, to start things off here, Bank of America's brand is under attack. This is a lawsuit that's been going on for a couple of years now. It involves one of the government programs, the HAMP program that was for modifying mortgages. What's going on here? Are you worried about the brand?
I'm a little worried. I mean, you had employees come out and testify and under oath that they're telling the truth under what was going on during this program. And I'm really concerned that this is a culture that might permeate throughout the bank, and this is just the mortgage group. But what if the investment bank gets this reputation for not putting its clients first? I'm a little concerned. What do you think?
First of all, you're taking it from the mortgages to the investment bank. I know you want me to play the ever bullish part here, and I will for a moment. And that's that, in terms of Bank of America's brand, this is a brand that people all over the country know. So there's definitely value to that, and there's value to the fact that customers are going to recognize that brand, recognize the company wherever they go. It's kind of like a McDonald's type thing. You sort of know what you're going to get. On the other hand, I do not like what I'm hearing coming out in these depositions, and so I'm going to be watching closely because there's only so much damage that the brand can take before that becomes a liability, that people see that brand and they say, oh, I don't want anything to do with it.
Yeah, and when we talk about something like a brand, it's damaging right now. It doesn't have to always be this way. They can make a change. Brian Moynihan and his management team, they can change the culture if they really put their mind to doing it. It's going to be a process, and they have to incrementally serve those customers, serve those clients, and over time, it will get better if they put in the work.
From Bank of America in America to Citigroup in new places, where is Citigroup going these days?
Citigroup has gotten preliminary approval to open physical presence in Iraq.
Of course they have.
The booming economy of Iraq, which they actually say over the long run, they said in 2050, they expect Iraq to be this booming economy that they want to be a part of. So I got to give them credit for their long-term thinking. I mean,
that is
2050, that's a long time away, but I'm a little hesitant to give them total credit for opening up all these physical locations again. I mean, they've come out and said that they want to be in the top 150 cities and dominate those markets. And now they're opening physical presences in Iraq. I'm not sure if I'm on board with the strategy of just opening stuff everywhere. You look at JP Morgan, they don't have to have offices everywhere, but they do have a very, very large not physical presence, just presence in international markets. So I'm not sure if I'm on board with the physical locations. I like how they're going internationally. That's where the growth is going to be for a Bank of America, a JP Morgan, a Citigroup. Just not sure if I'm on board with this exact strategy.
Now, the Wall Street Journal ran an article this morning about crisis planning and banks trying to get ahead of regulators in terms of what kind of capital they'll need to hold to be able to support themselves and support their bank subsidiaries in another crisis. And this is obviously going to pertain most to the biggest banks out there, to the JP Morgan, Citigroup, Bank of America, and Wells Fargo. Those are the big four, and those are the ones that are going to be most affected by new regulations. Essentially, what they're looking at is trying to argue that if they hold a combination of equity and long-term debt at a certain level of their risk-weighted assets, that'll give them the cushion that they need to be able to fund their banking subsidiaries in another crisis. The reason that investors are going to want to keep a close eye on this is for the amount of long-term debt that they're going to be required to hold. I mean, if this becomes the regulation, what some of the banks have been doing, Bank of America and Citigroup in particular, is reducing the amount of long-term debt on their books over the past few years. As the margins that they've seen between what they get on their lending and what they pay to borrow money, so that interest rate spread, that's been crunching down, and the way that Bank of America, Citigroup, and some of the other banks have been addressing that is by reducing their long-term debt, which tends to have higher interest rates. Mm-hmm. So if they're required to hold on to more long-term debt, that could stymie that process. And turning from there, Blackstone, KKR, some of the other big, really moving this morning. Blackstone was down about 5%. KKR was down more than 5%. I took a closer look at Blackstone to figure out what was going on there. No real news today, but you've got the market down. It was about 1.5%, almost 2% at times this morning. One thing that we don't talk about a whole lot here is beta. Beta is the amount that a stock moves in relation to the rest of the market. Blackstone's beta is up over 2, which means that it moves a lot more than the rest of the market. So on a day like today, when the market is being volatile, you'll see Blackstone stock being even more volatile. So I don't think that this move in particular is reason for investors to freak out. This is just a sign of Blackstone being a more volatile stock.
I think it's also worth noting that Blackstone is a pretty big dividend payer, and we've seen dividend payers sell off during this interest rate environment. People aren't sure if rates are moving up, so I think that might be another reason that that's moving a little bit more. To piggyback off the dividend players, moving to the mortgage REIT space, which has just been under attack the last couple months or so. And the pain continues this morning. We have Annaly down, AG&C down, Two Harbors down, Armor down big. It seems like every day, and this is just continuing from if interest rates rise, their book values will take a hit. And I looked at Annaly specifically in terms of a price to book value ratio. Its current price to book value ratio is the lowest in 13 and a half years. So it's the cheapest the stock has been in 13 and a half years. That goes back to
long-term thinking there.
January 14th, 1999 was the last time you could get Annaly Capital this cheap. So the last couple of years, they've been great for these mortgage REITs. They had widening interest rate margins or interest rate spreads, and the prepayment speeds weren't as fast as normal in terms of a falling interest rate environment because people were underwater in their homes. They couldn't refinance their mortgages. So the last couple of years have been great for these companies. Going forward, I think it's going to be a continued struggle, and I'm not sure if I'm jumping in yet. It might still have some more pain to get through.
Okay. And to close this out, David, I've got a little message for Bank of America. Bank of America, Brian Moynihan, what do I even say to you? All of this coming out, look, as investors, I'm an investor. There's a lot of other investors out there. There are a lot of investors that are watching this right now. What we foolish investors want is long-term, not short-term. We want you to think about the long term, and thinking about the long term doesn't mean reducing cost so much in your foreclosure mitigation units that you're going to see these kind of lawsuits, that you're going to see this kind of behavior in the company. Forget the short-term profits. Think about building this business, creating a culture that's going to span for the long term, that's going to make customers happy for the long term, that's going to make shareholders happy for the long term, that's going to make people happy to work there. When people are focused on this short-term thinking, on short-term profits, on having to string along customers, the alleged stringing along of customers, I should say, that doesn't make employees happy. That doesn't make customers happy. And you know what? Right now, it's not making shareholders happy. Brian, get your act together. That's all I've got.